Last time, we buried a currency. The British pound, sterling, the money that ruled the world before the dollar. It did not crash. It bled out slowly over 60 years. And we ended on one question. Sterling only fell because an heir was already waiting, a dollar that had quietly overtaken it. So is anyone waiting now? Could the euro, the yuan, or gold actually be the dollar's successor? Today, we answer it, not with a prediction, but with a scorecard. Here is the reframe that changes everything. Being the world's reserve currency is not a popularity contest. It is a job with a demanding checklist. Plenty of countries resent the dollar. That was never the real question. The question is who can actually do the work, hold the world's savings in a market deep enough to absorb trillions, let money move freely in and out, and stay trusted through every crisis. So we will write down that job description, then grade all three candidates against it, fairly, both sides, every time. And the answer is not the one the doom headlines want, or the one the true believers want either.
So what does the job require? 5 things. First, a deep, safe home for the money, the one most people miss. Reserves are not cash in a vault. They are parked in bonds, mostly government bonds. So a reserve currency needs a government debt market that is enormous, liquid enough to trade in size without moving the price, and safe in a crisis. The US Treasury market, close to $30 trillion of it, is the deepest and most liquid on Earth. That is the dollar's single biggest advantage. It is the wall almost every rival hits. Second, an open door. A reserve manager must be able to move in and out freely, in size, at any hour, with no controls and no fear the exit closes. A currency you cannot freely get your money out of cannot hold the world's savings. Third, trust, rule of law, contracts enforced, a central bank that will not inflate the money away or bend to politics. It took the dollar a century to earn that. Fourth, network effects. Everyone uses the dollar because everyone else does, for pricing oil, invoicing trade, issuing debt. That loop is self-reinforcing. Reserve shares move in decades, not headlines. And fifth, a large open economy underneath it all. But here is the twist. Reserve share runs well ahead of economic size. The United States is about a quarter of the world economy, yet the dollar's share of reserves is more than double that. Size is necessary. It is not sufficient. And China is about to prove it.
Now, the scoreboard, as it stands today. Treat these as of the latest reading. They drift, and we have flagged the date. Start with reserves, the world's official savings. The dollar is about 57% of the reserves whose currency is disclosed. The euro is a distant second, at about a fifth. The yen and the pound sit around 5% each. And the Chinese yuan? Only about 2%. Now, trading. In the global currency markets, the dollar is on one side of nearly 9 in 10 of all trades. The euro is on roughly 3 in 10. The yuan has climbed to close to 9%, rising fast, but from almost nothing. And payments, the money actually moving across borders. The dollar is around half. The euro, around a quarter. Though that figure is flattered because it counts payments inside the eurozone itself. Strip those out, and the dollar's lead widens again. Here is the takeaway. By every live measure, reserves, trading, payments, the gap between the dollar and the number 2 is not narrow. It is a chasm. The story is a slow drift at the edges, not a horse race for the lead.
So let's grade them. Candidate 1, the euro. Start with its strongest case, because it is real. The euro is not a pretender. It is a genuine, functioning reserve currency, a durable number 2, the money of some 350 million people, an economy that rivals the United States, an independent central bank, strong rule of law. On trust and on economic scale, the euro scores high. Then it hits a wall, The first item on our checklist, and the hardest one. There is no single euro-wide safe asset at scale. The dollar's moat is one giant uniform treasury market. The euro does not have that. It has many. German bonds, French bonds, Italian bonds, and more than a dozen others, each a different size and risk. There is no joint eurobond deep enough to anchor the world's reserves. And the gap is concrete. Top-rated euro area government bonds add up to less than half the size of the bloc's economy. The equivalent pile of US treasuries is worth more than the entire American economy. So Europe cannot produce enough safe assets for the world to hold in dollar-scale quantity. And a shared currency was built without a shared treasury. In 2010 to 2012, that fault line nearly broke it. Now the counter, because the euro is trying. Its central bank is working to expand the supply of euro-safe assets and building a digital euro to close this gap. A live project, not a dead cause. But the verdict is simple. A real number two, structurally capped.
Candidate 2. The yuan, China's currency. Here, the story flips. The euro's problem is its bond market. The yuan's is its doors. The real case first, because it is genuine. China is the world's largest trading nation and its second largest economy, about 18% of world output. And the yuan's international use is genuinely rising from a low base. Its share of global currency trading has jumped from almost nothing. More of China's trade now settles in yuan, and China has built swap lines and its own payment rail, launched in 2015. In trade, the yuan is climbing. So why does it still barely register in the world's reserves? The doors. China runs a largely closed capital account. The onshore yuan is managed within a daily band, and a freer offshore yuan is walled apart. A reserve manager cannot freely move large sums in and out of Chinese assets at will. That fails our second criterion outright, and a trust discount does the rest. And here is the honest crux, stated without judgment. This is not mainly a gap China cannot close. It is a choice. Full convertibility would invite the volatile flows Beijing has walled out to keep control. A reserve currency needs an openness China has, so far, chosen not to grant. There is a real debate here. The economist Barry Eichengreen argues the yuan could win a limited reserve role even without fully opening up. The mainstream view holds that real reserve status still needs that openness. Both are serious. We predict neither. The verdict? The biggest economy that by design punches below its weight.
Candidate 3 is the strangest, and by one measure, the one that is actually winning. Gold. The case for gold is real. A story of central banks, not retail headlines. For 3 straight years, central banks bought gold at a record pace, more than 1,000 tons a year, roughly double the previous decade's average. In the latest year, the buying cooled to around 860 tons, still one of the 4 biggest years on record. And by one yardstick, gold has now passed the euro to become the world's number 2 reserve asset. Hold on to that phrase, reserve asset, because it is about to matter enormously. Why the buying? It traces partly to something we covered last time. After reserves held in dollars were frozen under sanctions, some central banks sped up their diversification, seeking a neutral reserve, one that is no one else's liability, that no government can switch off. And in surveys, most central banks say they expect to keep adding. So gold is the strongest mover on the board, which sets up the twist. Because being the fastest rising reserve asset and being able to replace the dollar are 2 completely different things.
Here is the twist. A reserve asset is not the same thing as a reserve currency, and gold cannot be one. Think about what the job needs. You have to invoice trade in it, issue debt in it, price oil, pay wages. You cannot do any of that in gold. Gold yields nothing. It pays no interest, and a central bank cannot conjure it in a crisis the way it can with its own currency. Gold can sit beside the world's currency reserves as a hedge. It cannot be the thing the world transacts in. Now the part almost no headline explains.
When you hear gold has overtaken the euro as the number 2 reserve asset, that ranking uses a different yardstick than the dollar's 57%. The 57 comes from a league table that counts currency reserves and leaves gold out entirely. The gold ranking counts total reserves, including gold, at today's market price. And the price of gold rose about a quarter in a single year, touching a record near $3,500 an ounce. So much of that climb is not central banks buying more metal. It is the same metal, marked at a higher price. So do not confuse the two. The dollar at 46% on the gold-inclusive yardstick and 57 on the currency league table are not a contradiction. The gap between them is mostly the price of gold, not the weakness of the dollar.
So run all 3 across the 5-part job and watch what happens. The euro, high on trust, high on economic scale, fails the safe asset test. No single deep market to hold the world's savings. The yuan, rising in trade, real scale behind it, fails the open door test by choice. And gold, a surging reserve asset, a genuine hedge, fails at the most basic level because it is not a currency at all. Every candidate scores well somewhere. Not one passes the whole checklist. And that is the honest answer to the question everyone asks. What replaces the dollar? Right now, measured against the actual job, nothing does. Not by itself. Whether any ever closes its gap is a genuine open question, argued on both sides. But that is a debate about the future. This is where the scorecard stands today.
So, the realistic middle, an answer that is neither doom nor complacency. If the dollar's share is drifting down, where is it actually going? The IMF studied exactly that, and the answer surprises almost everyone. The reserve share the dollar has shed since the start of the century, around 14 points, did not flow to the euro, the yen, or the pound. Their shares are flat to lower too. About a quarter went to the yuan, and about 3/4 went into a scattered basket of smaller ones: Australian and Canadian dollars, the Korean won, the Swedish krona, and more. Holdings of those grew from around $30 billion in the late 1990s to well over $1 trillion. That is the real shape of de-dollarization. Not one challenger seizing the crown. Many small players, each taking a sliver. And one myth to clear away. You will hear of a coming BRICS currency, or the IMF's own unit replacing the dollar. But the IMF's special drawing right is not money. It is a basket, a claim on other currencies, not something you can invoice or spend. It cannot be the successor either. So de-dollarization is real, but it is partial, it is gradual, and whether it speeds up is genuinely debated, not a collapse on a countdown.
So let's land the plane. Grade the candidates on the real job. And the honest answer is this. The euro has no single safe market to anchor the world's savings. The yuan is walled off by the very controls that give China its grip. And gold, for all its surge, is not a currency you can run the world's trade on. No single one passes the whole test. So the realistic future is not a coronation, one king handing the crown to the next. It is a slow, partial drift toward a more multipolar money world. The dollar still first by a wide margin, but sharing the room with a basket of smaller currencies, and with gold. That is not the dollar's death, and not its permanence. It is diversification, measured in decades, driven by structure, not headlines. So watch the checklist, not the countdown. One note, as always, this has been an educational analysis of how the monetary system works, not investment or political advice. The figures are dated and sourced. And that leaves one last thread. Every candidate we scored runs on the same 20th century plumbing, the same banks, messaging networks, and Treasury market. But money is starting to change shape. China already has a digital yuan. Europe is building a digital euro. Could a central bank digital currency finally rewrite the rules? Or is it just the same contest on new rails? That is where we follow the money next. This has been Money and Power Explained. Follow the money. It always leads to power.